An IPO or initial public offering is the first time an entrepreneur or a private company lists itself in the local stock exchange to sell the shares in the company to raise funds for further expansion and for meeting the expansion and growth strategies that they have come up with. Now, if you think about it, normally when an entrepreneur starts a business, it is with the initial seed capital or the money that she brings in from her savings or from her relatives and friends or a trusted group of shareholders who trust in her. Now, as the business grows, let's say in the garage of the entrepreneur's mother's home, she starts to approach the banks to fund the expansion and the growth. Now, you're very well aware, friends, that banks and financial institutions are extremely shrewd. And why not? They are in the market for making money for themselves. And so, obviously, and for a good reason, they charge a very high premium on the interest on the money that they lend to entrepreneurs. In most cases, financial institutions are also very risk averse, and they have their own offices filled with project financing consultants who advise whether it is wise to invest or not. Now, these put a huge strain on an entrepreneur's ability to raise more capital for expansion. Now, an entrepreneur will obviously lose some control when she dilutes her shareholding. Now, without listing her shares, she's 100% in control of her organization. She's the sole boss. But as soon as the ownership is shared, there is a loss of control. But on the flip side, the entrepreneur stands to raise a lot of money at a very discounted rate. But yes, having to sacrifice part of her ownership. Some smart companies indulge in a share buyback scheme to consolidate the shares back with a relevant few shareholders, and this increases the value of the company. But not everybody is in that particular privileged position to be able to do that. You need to have that kind of returns from your investment to be able to buy back your shares. Now, with an IPO, there are two options. Depending upon the jurisdiction of the country you list your stock in. Now, you can either set a listing price of, say, a basic 10 cents, and then based on the market demands, the market demand and supply curves and the economics of the markets, your share price can go up right up to the stratosphere. Or alternatively, you can use a market-based rate to set the initial price and then let the market demand and supply take it either way. Let them go crazy over your stock price. Now, normally, when you start off with an IPO, you normally enlist an underwriter. Now, an underwriter is used to underwrite the IPO, or in other words, the underwriter is willing to buy the shares at a certain price if the shares are not picked up at the advertised price or fall below the listing price. So the undertaker obviously carries a risk. And so there is a risk premium attached to underwriting your shares during an IPO. Now, if I were to give you an example, if you look at the share price evolution of Apple, when they first listed it in the stock markets on the 12th of December 1980. To be very precise, it was listed at $22. Today, in 2020, with all these pandemics that we've been having, it trades at $283, and over the period of last 25 or so years, the company that was absolutely nothing grew to be the largest company in the world based on the market capitalization of close to $1.3 trillion. A huge whopping increase. The market capitalization is simply the amount of shares multiplied by the market price. Or in other words, this is the price willing to be paid by the public to own the company. So imagine if you wanted to buy Apple, you would be expected to fork out 1.3 trillion. However, if you read through the history and the journey of this beautiful fairy tale story, you realize that the founder, Steve Jobs himself, was voted out of his own organization by the board, who acted on behalf of the shareholders. Imagine being kicked out of your own company. He, of course, returned in time to take the reins of his company and take it again to another huge high. But yes, it is true that an IPO can diminish and undermine the control of an entrepreneur over the organization that she has created. But friends, just in summary, an IPO is extremely important for an entrepreneur if she decides to go for further expansion and she's not getting the right kind of capital from the financial institutions.